Good day, doctor and everyone. I'm Lim Xiu Zi. Now, today we are presenting about Petronas Chemical Group Berhad, or PCG, and an overview of its current strategic landscape. First, let me begin by introducing PCG as an organization. Petronas Chemical Berhad is a subsidiary of Petronas, which provides it with strong backing from a national energy champion. This relationship gives PCG advantage in terms of feedback security, skills, and governance stability. In terms of capacity, PCG operates with a production capacity exceeding 12 million tons per year, making it one of the largest integrated chemical producer in Southeast Asia. So its business scope covers basic chemicals, derivative chemicals, and specialties chemicals, allowing PCG to operate across a wide spectrum of the chemical value chain. So this integrated structure strengthens its market presence and supports long-term competitiveness. Moving on is PCG's 3 years financial performance. From year 2021 to year 2023, PCG's revenue shows clear fluctuation. Revenue increased from Rm 21.5 billion in 2021 to a peak of Rm 30.9 billion in year 2022, before declining slightly to Rm 28.6 billion in year 2023. This trend reflects the volatility of commodity price and changing global market demand, which is typical of companies operating in petrochemical industry. Next, the net profit allowed a similar pattern. It peaked at Rm 5.2 billion in year 2022, compared to Rm 3.6 billion in year 2021 and Rm 3.8 billion in year 2023. Gross margin also reached its highest level in year 2022 at 28.7%, before declining to 22.9% in year 2023. Despite its volatility, PCG maintains strong financial health. Return on assets increased from 6.8% in year 2021 to 8.9% in year 2022, before settling at 6.2% in year 2023. Similarly, return on equity rose from 9.2% to 11.5%, and then moderate to 8.1%. These figures indicate that PCG remains profitable and financially resilient, even in a cycle industry environment. In addition, PCG has consistently maintained a strong balance sheet and held cash flow throughout the 3-year period. This financial stability is important because it allows PCG to sustain operations, manage market downturns, and invest in future strategy initiatives even when facing inflation in commodity price and demand. Next, I will explain about the external winds. Starting with opportunities from the external environment, PCG is well-positioned in benefit from several key global trends. First, the global energy transition is driving rising demand for bio-based chemicals, chemical recycling, and circular economy solutions, which aligns closely with Petronas' net zero ambition. Second, regional market growth supported by RCEP opens wider access to high-growth Asian markets such as China, India, and Southeast Asia, where expanding middle-class demand continues to support chemical consumption. Third, digitalization presents strong upside potential. The adoption of AI, IoT, and advanced analytics can significantly improve operational efficiency, cost control, and supply chain optimization. Finally, growth is specialist segments, particularly electronics, electric vehicle, and advanced manufacturing, creates opportunities for PCG to move into higher value added specialty chemicals and performance materials. However, PCG also faces several external threats. Economic cycle volatility remains a major risk as a global slowdown and the cyclical nature of the petrochemical industry can lead to demand construction, overcapacity, and price pressure. In addition, tightening regulations such as carbon-related policies and stricter ESG requirements are increasingly complex costs and capital expenditure. Geopolitical and trend uncertainties, including protectionism and supply chain distribution, further threaten export stability and feedback security. Lastly, competition is intensifying with pressure from global giants like BASF and SABIC, as well as low-cost Middle East and regional producers, putting sustained pressure on margins and market share. Next, my group member will continue with the internal assets. Thank you.
Okay, thanks for my friend for introducing the introduction part. So for my part, I will continue on the internal asset. Okay, these sections shift our focus from external environment to PCG in internal situation. Internal assets are critical because they determine whether the company can realistically execute any chosen strategy. By analysis PCG strength and weaknesses, we can assess how well existing resources, capability, and organization structure support long-term competitiveness and transformation. For my next slide, we will see the strength. PCG first major strength is its scale and upstream integration with Petronas, which ensures stable feedstock supply and cost competitiveness, an advantage many competitors that very lacking. Secondly, PCG's strong balance sheet and cash flow provide resilience during industry downturn and the ability to fund strategic investment. The company's strategic production layout across Peninsula, Malaysia, and Sarawak enhance logistic efficiency and market access. Finally, PCG robust governance and compliance framework reduce regulatory risk and strengthen stakeholder confidence, particularly in highly regulated industry. Next, the weaknesses. Despite these strengths, PCG faced several internal weaknesses that constrain future growth. R&D investment remain relatively low compared to global chemical leaders, limiting the development of high-value specificity products. Digital maturity is also lagging, meaning PCG has not fully leveraged Industry 4.0 technologies for smart manufacturing and data-driven decision-making. In addition, there is a shortage of talent in advanced material, data analytics, and sustainability. Lastly, heavy reliance on commodity, chemical, and Southern Asia market increased exposure to cyclical and regional economic risks. Okay, next, I will go on PCG SWOT metric involving strength, weaknesses, opportunity, and threats. Okay, this is our usual for strategic quadrant. We have strength, that is growth, defensive, improvement, and defensive threat. Okay, the SWOT metric integrate internal and external analysis to provide a holistic strategic view. It shows that PCG strengths such as scale, integration, and financial resilience can be used to pursue growth opportunity in sustainability and chemical specialty. However, weaknesses in innovation and digital capability must be addressed urgently. The metric also highlights that purely defensive strategies are insufficient. PCG need to proactive approach that balance risk management with long-term transformation. Okay, next, we go to part C, three strategic pathway. Based on SWOT analysis, we identify three distinct strategic pathway. Each pathway represent a different response to PCG challenge and opportunity. This option vary in risk, investment requirement, and time horizon. Evaluating them have determined which strategy best align with PCG capability, market realities, and long-term objective. Okay, option one is operational excellence. Okay, the first option focus on operational excellence in bulk chemical. The objective is to maintain cost leadership through asset optimization, energy efficiency, and tighter supply chain management. This strategy aims to stabilize cash flow and protect profitability during industry downturn. While this option is low risk and built on existing capability, it offers limited long-term differentiation and does not fully address PCG exposure to industry cyclicality. Okay, we have option two. The second option emphasize differentiate the growth by accelerating PCG shift towards special chemical. This includes expanding into high growth segments such as electronic chemical, advanced polymer, and sustainable material. Strategy acquisition, joint venture, and application focused innovation are the key enabler. This strategy reduce reliance on commodity product, unlock premium pricing, and lower earning volatility. Although it requires new capability and high investment, it offers the strong long-term growth potential. We have option three, sustainability leadership. The top option positions sustainability as a core competitive advantage. This involves investing in circular economic solution, chemical recycling, renewable feedstock, and carbon reduction technologies. By embedding ESG consideration, environment, social, and government into decision making, PCG can strengthen its license to operate and appeal to environmentally conscious customers and investors. However, the strategy requires significant capital and has a longer payback period, making it more suitable as a complementary rather than standalone approach. Okay, for part 7, I will hand it to my team.
Hello, everyone. We have now reached the decision points, part 7. After thorough evaluation, we select differentiated growth option 2 as our core strategy, supported by operational excellence for cash flow, stability and sustainability, leadership for long-term license to operate. This combination scores highest across strategic fit, competitive advantage, long-term upsides, and the risk control, the optimal balanced choice today. The roadmap has 3 clear phases: short-term 0 to 6 months, portfolio review, digital baseline, partner shortlisting; medium term 6 to 12 months, launch specialty, pilot plants, build integrated IT platform, the establish and active innovation fund; long term 12 to 8 months, restructure restructure organization, accelerate CapEx processes, build global talent pipeline. We aim to move to rapidly from diagnosis, pilots, scaled transformation. So now we move on to part 8. Execution depends on resource alignment. 3 firms measures. The first, greater than 40% of CapEx allocated to growth projects. Second, create USD 200 million dedicated innovation fund for high potential ventures. Third, significantly weight variable pay towards strategic KPIs, specialty revenue share, green products ratio, etc. Only when capital and incentive are aligned will execution truly happen. A balanced scorecard will track financial specialty margin and ROI, customer green material share, process new product speed, reliability, learning and growth R and D, talent plus digital matu- maturity. This projects short-term health while building long-term capabilities. So now we move on to part 9. In closing, PCG's strategic imperative today is to balance survival and transformation. We have scale and financial resilience, our strength, but we must urgently close gaps in innovation, digital maturity, and talent. Is existential. Externally, we face both green premier opportunities and ongoing cyclical regulatory and geopolitics and headwinds. Our choosing approach puts differentiation and growth at the center, protected by operational excellence and credentialed by sustainability. This is a demanding journey, but it is the most credible path for evolve from regional scale champion into global value champion. So this is our presentation. Thank you very much for your attention. I welcome questions, comments, and suggestions. Let's turn this blueprint into reality together. Thank you.